All right, good morning, everyone. We'll go ahead and get started. I think we're going to have folks sort of trickling in, but we have 90 minutes and a wealth of knowledge coming from our panelists, so I want to jump in right away. For those of you who don't know me, I'm the voice behind the emails or LinkedIn notifications you got about this event. I'm Sarah Schaff, the director here at Gary. Gary is the Global Adaptation and Resilience Investment Working Group. We're a global nonprofit based here in the US, and we've been around for 10 years, convening investors and other stakeholders focused on how do we get more private capital into adaptation and resilience globally, and especially on the product and service side. I think there's a lot of folks doing really smart research and thought leadership and moving the how do we incorporate risk into financial systems. And so we're really focused on as the world is changing, unfortunately, um, individuals, companies, communities, countries need different things. We're going to need different things to adapt to our changing climate. And so that's really what's brought us here today. So this session, this webinar is really focused on a sub-region of sort of this global change, which is focused on sub-Saharan Africa, where we have a combination of least developed countries, middle income countries, really developed cities, and really rural areas that are all experiencing the impacts of climate change, often in very visceral ways. We have flash flooding that is impacting agriculture in certain, sub-regions, and then we have drought the same years affecting agriculture in other sectors and other regions. And so this is one of those places where that question around we see the climate changing right now. We know that private capital is already difficult to invest in some of these areas. How do we actually address that question? So it's really what has brought us here today. A couple of logistics. We're going to have a fairly large panel and we're expecting quite a few audience members here. So we're asking everybody to very actively use the chat. I have a research intern, Eleanor, who's going to be monitoring the chat. So you can look for her and know that she is helping on behalf of Gary to keep those questions flowing. We're going to spend about 60 minutes with some questions that I've set up, but then we're really wanting to answer a lot of audience questions. I think a lot of you have probably come because of the wealth of knowledge coming from these panelists, but we really have representation across the financing system from incredibly early stage to more sort of growth equity companies and investors that are really thoughtful around how do we fill this gap. So please ask those questions. You can kind of, start from the beginning, putting those in, and we will try to filter those at the end for some of the questions that we think are a best fit for this panel. And with that, sort of a note about this program and a lot of others we've been implementing. This is part of the Climate Adaptation, Innovation, and Learning program. It is funded by the Global Environmental Facility, implemented through partners at UNIDO. And we're really excited to have the time and funding to ask these questions. One of the topics that's come up multiple times, and I'm going to pass it over to Jason here in a minute, and he might expand on this as well, is I'm sitting here in the US. A lot of our investors, even focused here, are sitting in the US within a country that has a pretty efficient capital market structure. Places that have efficient capital markets can figure out how to move capital into these innovations and get the innovations into products and services that people need at approximate prices that people can afford. But that's not true all over the world. And so the ability for grant funded programs like this to ask those bigger questions, for us to be kind of thoughtful about it, innovative, is really important. And so with that, I'm going to pass it over to Jason for just a couple of comments from the Jeff.
Sarah, thank you so much. And thank you for convening this this discussion on this really important topic. I am excited by the huge amount of expertise and diversity of perspectives on this call. So the Global Environment Facility is a funder of Gary. We're a very proud partner and have been for a number of years, especially because we value the shift and development in the climate adaptation and resilience investment community on understanding the opportunity of investing in adaptation and resilience. We've seen a real change in the right direction of understanding adaptation and resilience as a moral issue and which it is, and a purely public issue to being existential for risk management for every company in the world, as well as for every household and country. And now, um, an increasingly undeniable opportunity, unavoidable opportunity. Uh, so this is exciting, the understanding the upside of investing in adaptation and resilience. And we've seen a sea change in recent years, a big but, and in a really important but. Is this true for the most vulnerable? Is it true for least developed countries and SIDS and vulnerable populations within all countries? Or will those with ability to pay be the ones that can adapt? Will the rich be able to adapt? The rich be able to afford air conditioning and maybe even green air conditioning and irrigation systems and early warning systems, or will yet again LDCs, SIDS, and the most vulnerable, including women, indigenous peoples, etc., be left behind? So this is a crucial question, and that's why I'm so glad for the topic of this webinar, Sub-Saharan Africa. Issues like how do we blend finance to de-risk and attract finance into vulnerable contexts? What are the different policy environments that we need to develop, and what are our examples, and who are the Southern-based fund managers that we need to support? We've seen a wave of fund managers from the global north investing in the global south. Excellent, wonderful. We also need to be identifying and supporting global south fund managers. I understand, for example, Kenya Ventures is on the call, and maybe they'll have some insights. I'm seeing Miles Carrero of Catalyst Fund. I'm sure you'll have insights in this area as well. Back to you, Sarah. Thank you so much, and looking forward to the next hour and a half.
Thank you, Jason. We're going to just very quickly pause. Like I said, we have a lot of panelists. I can see most of them, but if you can all raise your hands so that I can get everybody onto the screen, and then we will start. Okay, if everybody on the panel can lower their hand, and I think I've got one more to add. Let's see, there's. Okay. We perfectly have 9 panelists plus me. So you can hear my voice, but I'm not sure how this is portraying everywhere else, but you shouldn't be able to see my face because I really want to make sure that the panelists are highlighted. So hopefully this works. Um, Again, thank you everybody for joining, and thank you for so many of our panelists. We don't have a lot of time, and so we're really going to jump in. Some of the biggest questions that we really want to cover here are on the two different sides of the experience of an investor, which is raising money, who is actually investing, who are the capital allocators. Most of the folks here are fund managers or investors that are sort of getting capital from somewhere else. We've got a bit of a mix. And then also on the pipeline side, where are you investing? How are you identifying these companies? And then how are you sort of structuring those investments appropriately? And again, we have just a huge range here. So to start off, we have just a very quick question, and I would like each of you to answer this question, and hopefully you can just jump in to move quickly. But please introduce just very quickly your name and then your organization and like one sentence of how your organization fits into this whole ecosystem. And then the question is, when we hear this statement, there's not enough deal flow, especially in adaptation in sub-Saharan Africa. What are the people who are saying that there's not enough deal flow misunderstanding? So, to kick it off, I'm just going to start at my top left. May Alice, if you can start us off.
Sure thing. Thanks, Sarah. Hi, everyone. Pleasure to be here. I'm Maylise. I'm the managing partner and founder of the Catalyst Fund. And Catalyst is an early stage venture capital fund and venture builder investing in climate resilience and adaptation across Africa. We launched a fund, this one, in 2023. And so we've been investing for now 3 years and built a portfolio of 26 companies in adaptation and resilience specifically across about 10 markets. So I think we've learned a few things specifically about pipeline in that time. And I think that's how we fit into this conversation. And do you want me to address your first question as well?
Yes.
Right off the bat?
Yeah.
Okay. So I think from our perspective, we invest early stage, pre-seed to Series A, and we're not seeing a shortage of startups advancing adaptation and resilience outcomes. The pipeline is there. I think the issue is not scarcity, but it's identification, because a lot of the companies that are most impactful don't actually self-identify as adaptation companies, but they self-identify as an ag tech company or an insurance company or a water management company or a climate data and AI company. But the resilience outcome that they deliver is what we're looking for. So I think that as a fund, we actually took a broad definition, and we look for companies that advance products and solutions that help communities manage risk in the short term, that help communities adapt their livelihoods to climate change, and also build a long-term resilience, which gives you the breadth of basically solutions that also consider the upside of adapting in the future. So that's the long-term element of it. And with that, we do see a healthy pipeline, but you do have to do the work of honest, deep due diligence with the necessary know-how internally as part of the team to understand what adaptation outcomes the solution will actually deliver over time. So that's how we see it.
Thanks, Miley. So I've got a note. It's not a pipeline issue at the early stage, but one of the most important pieces is you're looking for companies that aren't calling themselves adaptation companies or adaptation products, but based on needs, you're finding them. I think that's an important piece of that. Okay, next up on my grid is Addie from Autodesk Foundation.
Thanks, Sarah. Hi everyone. I'm Ade. I'm an investor at Autodesk Foundation. So, for if you don't know, Autodesk Foundation is a philanthropic arm of Autodesk Inc. So we invest in climate adaptation and resilience solutions, and we look at how do we use design and engineering to unlock and scale catalytic innovation. Right off to your question, I think I agree with Melis. There are two things that I think are top of mind. First is A&R is a fairly new framing, right? So when you go to African communities, work on energy, ag, and water has been happening for a while. So we need some adjustment, right? How can we enable entrepreneurs to understand how to tell the stories to both local and international investors? Because we find that startups that can unlock funding from both angles will typically do better. I think the second thing I want to highlight is when we think about adaptation, it involves like public goods like flood defenses, water systems, early warning systems. And I think we're still at the stage where we need to figure out who pays for what. Because once we figure that out, we're able to unlock bankability for these solutions in the later on investment stages.
Thanks, Addie. I'm really glad that you brought up this question around adaptation products and services is incredibly broad. Some of it is very much on the infrastructure side, but there are different needs as far as capital funding those different pieces. And I think we are going to very much touch on that today. So thank you. Next up, we have Amaka from Weave Capital.
Hi, everyone. So my name is Amaka Okechukwu-Opara. I'm the founding partner of Weave Capital. We're a gender lens early stage fund, venture capital fund based in Lagos, Nigeria. We invest in the future of climate, the future of finance, and the future of work in Nigeria and Ghana. And we've invested in companies. You're very, very intentional about investing in the future of climate for Africa. And so we have companies, in sustainable agriculture, in renewable energy companies on our portfolio. And so, that's Weave in a nutshell. To answer that question, I would say that, similarly, I don't think we have a pipeline issue. What I would say, though, is that these companies are not found in typical, would I say, venture capital, private equity ecosystems. And so to actually find them, you would typically go through industry where they sort of self-identify, right? So it's very interesting in terms of how you would then build that pipeline, because you wouldn't find them in the typical ecosystem plays. Another thing that I would say in terms of just, I'll say the difference between these companies is that there's deep work that is needed on one, just finding the right instrument. So it's not enough typically to just come in with an equity play. We find, and I'm sure we'll touch base on this in these conversations, but equity is just not enough. There is a lot of financing that's required in terms of debt and working capital for these companies. And yeah, there's also work on technical assistance, which is a big part of what we do at Weave, to really support these companies to scale. So effectively, I'll say that it's not a pipeline issue. I think it's there's several things at play here, but definitely not a pipeline issue.
Thanks, Amaka. That's a good reminder that even a conversation like this that has some focusing on sub-Saharan Africa, we could have a whole session focused maybe on an individual sector where we really can kind of deep dive and address that question. The conversation has kind of blown up in a great way. We better understand this. So I think that's a great reminder, just that I'm excited to talk later about the different types of capital, but also that point around pipeline. A lot of it, you go within the sector or within even specific companies. What are the needs that they need? And all of a sudden, you realize there's all of these different innovations and companies within their supply chain that fit. So I think that's a really great point that very much agrees with Mayalis's point as well. Okay, up next we have Chris from Acumen.
Thanks, Sarah. And great to go after distinguished colleagues here who've hammered home some really good points. I head up Acumen's earliest stage agriculture investing under an initiative called Trellis, which is a $30 million pre-seed and seed state initiative that deploys often first institutional tickets into companies solving income resilience and climate resilience problems for smallholder agriculture, primarily East and West Africa with some exposure to India and Latin America. We're about 14 deals into a 30-deal mandate, which will run through 2028. And yeah, identification, the theme coming out is a big one. We've been blessed with local teams operating out of our Lagos and Kenya offices who are integrating the communities and can find just the type of pipeline that Miley's and others Amaka mentioned. They're not in the typical places. They don't always have the glossy decks, but they're solving these solutions. And I think the only other thing I want to add is that if people say there isn't enough deal flow, it's often because they're mistaking it doesn't fit my mandate for it doesn't exist. So adaptation businesses are everywhere, but they look different than what people are expecting. They're distributed infrastructure, not software companies. They grow on agriculture and climate timelines, not quarterly growth curves, right? So pipeline is there. It's just structurally different from what a lot of global investors are trained to underwrite. And I think that's an important distinction.
Thanks, Chris. I think that comment is going to touch on something that we'll definitely talk about later, which really is existing financing structures or maybe traditional investment structures globally don't necessarily fit. And so then you kind of miss the pipeline. And I think up next I have Sandrine, who could talk about that, I know, with her fund structure, but would love just a very brief intro. And then just back to the question in case we've already kind of lost it. We're talking about there's this mistaken idea that there's not enough deal flow. Obviously, everybody on this call has a perspective that there's plenty of deal flow because they're doing it. So, Sandrine, what's your answer to that question?
Thank you so much. So, Sandrine at EG Capital, we're a climate adaptation fund manager, and we have a focus on 80% LDC markets. So, love the point earlier from Jason in terms of how do we know that it is going to the right places and not just being generically in the right countries or the right sector. I think the question of definition is really important. And for us, climate adaptation and resilience is the ability of a community or a business to respond to the climate shocks and prevent them. So it can be prevention and it can be how do we respond when the shock has happened. So that definition is important. And we've also contributed to the latest measurement toolkit with the UNFFI community of practice for climate adaptation metrics, which I think is a step forward also into the discussion. And so we feel that on one part, it's a definition question. The other part is a cost of capital question. So we're a private debt growth fund, and we've used the blended finance structure on the downside to protect the downside, but also to have some level of catalytic capital is really needed, first loss junior equity, not just for the downside, but also for the return upside. And that return upside, by having junior equity returns capped, is not only going to senior investors when they're investing in LDC high risk markets, but in case for us, it's also going to the portfolio company into lower cost of lending. A country like Zambia has experienced the worst drought it has over the last 20 years. And for our companies, that meant 20 out of 24 hours, they could not operate. And those are companies, for us, it's in food security, it's in health, it's in education. Those are essential services you really want to continue when you have a shock. So, the diesel generators, they don't really do the trick, and they really needed a $5 million solar investment to be at least 30% independent from the grid. And a company in Zambia is operating in a country where local banks are lending between 20 to 40%, right? So there is an issue with cost of capital in Africa, and it's a bit weird for an investor to say that, but as part of our impact, lower cost of lending to the portfolio company is also part of the equation. Like, not only it has to be a pipeline that does fix an issue for climate adaptation, it also has to be affordable debt.
Thanks, Sandrine. And up next, Matt Eldridge.
Thanks, Sarah. Hi, everyone. Matt Eldridge. I'm advising the Gates Foundation on scaling investment in climate resilient agriculture. The Gates Foundation's work on adaptation is focused on climate resilient food and health systems, and we've made a commitment of $1.4 billion in grants over the 2026 to 2029 period to help smallholder farmers adapt to climate change. In response to the question, within agriculture, there's substantial demand from small-scale producers for productivity and resilience-enhancing solutions like improved seed, irrigation, soil health inputs, et cetera. And we've seen advancement in how technologies such as affordable solar pumps, stress and pest-resistant seeds, biofertilizers, things like that, as well as local partners primed to support uptake. So what's really constrained is not demand or absence of opportunity, but rather readiness to absorb capital, proven business models, high transaction costs relative to ticket sizes, and questions about risk allocation. So as we seek to scale technology diffusion that's affordable for farmers, but financially viable for commercial markets, we're really aware of these barriers and working with partners to address them so that we build viable markets rather than individual investments.
Thanks, Matt. And next is Kit.
Yeah, thanks, Sarah. Hi, I'm Kiet Tucker. I'm with Factor E. Factor E is an early stage climate technology and innovation impact investor, and we invest both in climate mitigation and in adaptation. And I think from our perspective and thinking specifically about technology and innovation, I'm sure most people in this call are familiar, but we still have 65% of climate tech equity capital flowing to North America. Africa receives a fraction of the capital that it needs, and virtually none of that goes into early stage R&D, particularly in deep tech and innovation. And so from our perspective, when international investors say they can't find investable pipeline here, what's missing isn't the entrepreneurs, it's often the innovation itself reaching these markets. You look and you see technologies in cooling and post-harvest loss reduction and atmospheric water capture and desalination. These things all exist globally, but they're not being adapted and transferred into the African context. And so if we're serious about building an adaptation pipeline that meets the urgency of the need that we all see, it's going to be critical to bring tech transfer in alongside homegrown innovation. And that's what we're working on at Factory.
Thanks, Kiet. Up next is Lizzie.
Hi, yeah, Lizzie Merrill from Ground Up Investing. We invest in agri-food systems, both in LATAM and in Sub-Saharan Africa. To sort of answer the question, we definitely don't have a pipeline issue. For us, it's really like what stage of funding the company is at. We see, a lot of very, very early stage, and a lot of people on this call have touched on that you really need to right size the capital and sort of fix it so that they can become more investable for the sort of market rate entrepreneurs. And that's sort of where we sit, is looking at those companies just a little before they might be market rate, and helping build up those investment pipelines. So there's a lot of companies there. They just might be a little too early stage for some of the people that are looking at investing in them.
Thanks, Lizzie. And finally, to round out our 9 panelists, Tofin. Oh.
Can you hear me? Okay, excellent. Thanks for having me. Yeah, Zofen Kama, I lead the investment for Mexico Ventures here in Africa. Just a few words. We've been investing in agriculture and food systems and overall climate adaptation for the last 10 years, actually 11 now. So we have probably one of the largest portfolio, about 62 companies spread across Africa and LATAM. So we have that visibility on both sides. And yeah, definitely, just to respond to the question about adaptation, we have a particular view on this. I think most of the time people feel like there is a gap in terms of pipeline. First of all, because maybe the kind of adaptation they're looking for is probably not exactly the same as what most founders are basically building for. Like, for example, in agriculture, almost everything needs to take into account adaptation. In supply chains, is the same. So the typical example I take is the mentioned structure in the Japanese construction industry. You can't build a building without that. So we'll get to a point where you can probably not build a proper company, long-term company in this region without taking into account adaptation and resilience. So there is absolutely not a problem of basically pipeline. Now, there is a serious questions about the mechanism to invest, like the liquidity, whether we use international or local liquidity, and also the type of instrument, whether it should be equity or debt or a mix of debt and equity. But the problem is definitely not a problem of pipeline.
I think we've addressed that question just from these panelists, and I think anybody showing up to this session knew the answer was there is plenty of pipeline. And I really like that just these first answers really touched on one of the core themes, which is when you're operating in an area that is very obviously experiencing the impacts of climate change. A lot of these investors focus on agriculture and food systems, or at least touch on agriculture and food systems. Adaptation isn't optional. You're dealing within a system, within a sector that is already being impacted. And so a financially smart investment incorporates adaptation and resilience. And so I think that's really important that this has already sort of touched on that. Some of the rest of the questions for the panel are really going to focus more specifically on where they're seeing pipeline, what makes those companies investable, and then also touching on where the money is coming from itself. And I think that's going to connect to another through line that everybody touched on, which is the right type of capital and the right instruments. So I think that's going to be a really important through line kind of going forward here. So I've sort of attempted some of my questions to start at the earliest stages and then kind of move into the growth equity. I'm really glad that, for example, Sandrine's on this call. I already saw a question or a comment in the chat about that growth equity piece because that often feels like a gap. But we are going to start at that sort of earlier side, which I think many of our investors here are focused on. So Miley, starting with you, you've been investing in this space for a very long time already. I think the Catalyst Fund is one of the most known funds to actually be focusing on ANR, and so you have a lot of that experience. What makes an adaptation company investable? And can you just talk a little bit more about like your model? What types of companies are you looking at, and like what type of capital are you providing to those companies?
Absolutely. And thanks. That's good to know. Although actually we're in very good company, I shall say, and many of our co-investors are in this room, and we need a lot more. So in fact, ideally, we would see this room grow 3 times as big next time we chat. That's at least our hope. But starting maybe with your second question, which is our model and what we look for. So as I mentioned earlier, we're an early stage investor. We invest at the pre-seed stage, and then we follow on at seed and Series A. So we really select the companies and the opportunities at the earliest stage of our development, but there needs to already be a product in market, some customer, some level of traction that we can assess and evaluate. And we evaluate that both on the longer term climate adaptation and resilience impact potential, because of course at the early stage, existing impact is there, but is still limited. And the financial upside, obviously, that a given investment can provide, given that we also have that fiduciary responsibility towards our own investors, and it is a commercial model. The other thing that differentiates us from other investors, and I'd say from a traditional VC model, is that we don't just invest capital. So the earliest stage, we know that companies operate in a difficult environment and that they need more than cash. And so we have an in-house team of venture builders that provide venture building support, which for us means working alongside founders as sort of co-CFOs, co-founders sometimes, or interim CTOs or interim head of products for 6 to 12 months, and really trying to de-risk the models at the beginning, accelerate the growth path so that other investors can come in, and also, frankly, increase the odds that more companies in the portfolio will succeed. So very much unlike a traditional Silicon Valley model, it's not about optimizing for 1 or 2 outliers. It's optimizing for a diversified, larger portfolio with a blended rate of returns, because that's the kind of breadth that we're seeing in the market, and also the breadth of approaches that are necessary really to scale companies, whether it's in agriculture, or in food systems, or in water, or in energy, or in mobility, etc. So that's sort of overall our approach. Now, in terms of the fundamentals, what we look for actually is not that different than what you would look for in other sectors, to be honest. We are looking at a strong team that has a genuine founder market fit, so deep understanding of the local context, deep understanding of the problem they're trying to solve, a compelling value proposition with the early signs, again, we're early stage, of a product market fit. And obviously, the closer to that, the better. We look for indicators of future revenue traction, growth potential, which could be, partnerships, or again, it could be initial revenue, but with the sort of a sign that it can really increase over time. And then also the founder's ability to raise capital and be very diligent with the use of capital, because you really need that in a difficult operating environment where capital is scarce. You have to be leaner. You have to be much more focused on profitability early on, unit economics, etc. So we really try to assess that from the early stage. So, with that, then comes the question of how is the solution really advancing adaptation and resilience outcomes? And that's baked into our overall assessment of whether that fits with our thesis. And if it doesn't, then it's a pass from the get-go. And then we deep diligence the rest of the areas in the rest of the DD path.
Maybe one follow-up question that I think is another one of those misunderstood things that I think you started to answer. So you said the answer to the question, what are you looking for? You're not really looking for anything different. You're just a good investor. You're looking for a good team. You're looking for the ability to raise capital. You have an interesting model that's providing a lot of support. I think we might touch later on through some of the investors around this ecosystem challenge. Many of the regions or even specific cities where you're investing in companies don't necessarily have the big, robust startup ecosystems that we might find in other places. But there are some really strong startup ecosystems, especially in places like Nairobi. So the question is, when you're going ahead and investing specifically in this A&R thesis, are the companies more risky because they're A&R companies, or are they just as risky as they would be if you sort of removed that adaptation lens and said, oh, this is a mobility company, or oh, this is sort of a general climate tech company?
I don't think they're more risky because they're adaptation and resilience. Maybe if I were to be completely honest, what makes it a little riskier right now is the availability of capital and the appetite of private capital to go into A&R. Like if you look overall at the share of capital coming from the private sector for Africa, according to CPI data, of total climate finance is less than 14%. And if you look just at adaptation, 98% comes from the public sector. So if, when you take that and you think, okay, who else is going to come and invest alongside me, after me, you already identify there is actually an issue that we're seeing at the growth stage, B and beyond, or even when we think about exit and liquidity, who's going to buy these companies eventually? That is a riskier, element, or something that we do consider, because obviously the companies have to be well capitalized to grow and then be of interest to potential future acquirers, and that's the model, right, that we are here to enable. But beyond that, the investor hesitation that we're seeing actually is largely around hardware. In a lot of adaptation and resilience models, it's not just software models. You have hardware, it's real economy business solving real problems for customers, and they also are more working capital intensive. Usually those two words don't go very well with the appetite of some investors, and hardware signals high capex, and investors don't like that, or they're uncomfortable with that if they're used to software models. But for example, in our portfolio, the best performing companies, and we have now 26, as I mentioned, we reclassify this every quarter, and the best performing ones are those that are hardware intensive and working capital intensive, but they're still being able to unlock much higher revenues, capital, like in different ways, in blended ways, and are scaling quite fast. So, again, not a red flag for us, but it requires some explaining sometimes with co-investors. And then the other hesitation we see is around exit pathways, not unfounded as a perception. And it's something that I think all investors investing in Africa are hyper aware of. But I do think actually there's more exit opportunities that maybe meets the eye. So one really needs to sort of build those relationships early with future acquirers. And frankly, as a sector, we have to build that track record so that we can unlock a lot more capital in the future.
Thanks, Maëlys. I think that's a great transition to a couple of questions for Kiet. Factor E has a really different model than I think most of the investors here, but I think one that's incredibly complementary. And you also have some experience on that exit side and some success of sort of exits. And so would love for you to just share just a tiny bit more about your model, but then touch on what I think Maëlys set up really well, which is this question on exits. And I think that you also might have something to share about, companies that are more hardware intensive and more working capital intensive. But again, just because your model is a little bit different, I think you have a little bit to share about what that success can look like on the exit side.
Yeah, thanks, Sarah. Yeah, so Factory's been investing for 12 years now in sub-Saharan Africa. We also used to deploy in India. We don't currently. And we've deployed 19 million into 38 companies. And from that portfolio, we have 8 exits, which is pretty unusual for the sectors, stages, and markets that we work in. And that's been a combination of oversubscribed secondary rounds and some M&A, mergers and acquisitions. And I think for us on the exit side, I think in terms of strategies that are replicable, one of the ways that we approach investment is we call it a cluster investment strategy. So we're mapping value chains. We're building out a really detailed thesis that spans that entire value chain. And then we're deploying capital into technologies and solutions and bigger sort of like platform scaling companies that touch different parts of that value chain. And what that does is it helps create complementary businesses that are supporting each other in the ecosystem. Sometimes they're directly selling services to one another. And then eventually, in some cases, that creates natural exit opportunities as those companies merge or acquire one another. And on the model side, Factory is unusual. We're a permanent capital vehicle, and all of our investment activity is housed under a nonprofit. So we are truly early stage catalytic capital, pre-seed to seed stage. And in America, we have an idiom about a wolf in sheep's clothing that sneaks in to get its prey. At Factory, we think of ourselves as a sheep in wolf's clothing. We're raising mostly concessionary capital, but it's really important that we think, look, and act like an investor so that we're having the right commercial signaling effects and we're building durable companies that can gain market traction and scale. But that type of concessional capital does afford us the ability to look more broadly. So if we don't see the technology solution that we're after in market, we can look around the world and we can invest in other markets. We can be really bespoke and flexible in whether we're doing a licensing deal, we're forming a new joint venture, we really try to be venture centric and just like meeting the needs of the solution we've identified and then supporting that on its journey, being very patient, very hands-on, very flexible to go on that journey as ventures scale and gain market traction. And by way of example, on the adaptation side and drawing on a few of the themes that have come up, it is hard work building a company on the market, on the ground in market in sub-Saharan Africa. And if you take a solar irrigation company like Sun Culture, who I'm sure most people are familiar with at this point, but they're a Kenyan company providing solar irrigation to smallholder farmers. Tremendous need here. Still in sub-Saharan Africa, only 4% of farmland is irrigated. And some culture system increases yields 2 to 5x. And if you imagine climate change and increasing persistence of droughts, it is just the impact on resilience in that type of a rainfall situation is dramatic. But building some culture has been it's just so hard. They design and manufacture their own IoT-enabled solar pump systems. They provide consumer financing through a pay-as-you-grow model because customers can't afford to pay upfront for the technology. They install, they train, they maintain, they sell and distribute and deliver. They've built a precision farming data platform that has hyper-local weather forecasts for their clients. And they're now also bundling in climate insurance. So here in one company, you have hardware manufacturing, you have fintech, you have agronomy, you have data analytics, you have distribution, you have insurance, all in one single operating structure. And that level of vertical integration, I'm sure other investors here will tell you, is not unique and it's not by choice. If you don't build that infrastructure around your product won't exist. And that means that growth takes time. It's slow. You have to grow farm by farm, district by district, country by country. And for Sun Culture, they now have 45,000 systems active in these markets. That's worth celebrating. And it's not hockey stick level growth. I think if you showed their growth chart to a Silicon Valley VC, they'd be pretty underwhelmed. And the last thing I'll mention is just on the capital side, Sun Culture, by most measures, had a great last round, an oversubscribed Series B, 27.5 million, marquee investor names like Reed Hastings. But it took so much work, and it was such a big coalition. They've got family offices, foundations, impact investors. I think Acumen came into that round, DFIs, carbon credit facilities. And this isn't a situation where you have a single lead investor who can write a big check, invite a few co-investors, and staple some debt on for good measure. This is a painstaking process of patching together all of these different investors round by round. And so it's really hard work and it takes a lot of time. I think I've covered a lot of ground. I'll stop there, Sarah.
Thanks, Kat. I wasn't sort of expecting you to explicitly talk about that company, and I think it's a good transition to focus on agriculture because that does touch on a lot of sectors that many of our investors here are focused on. But I think it's really important to just re-emphasize what you pointed out, which I know we've talked about before, but a lot of the investable or at least maybe exitable, the sort of at the growth stage companies are vertically integrated. I think that's a really important piece. And then the other piece that you just touched on with that fundraising, that very much reiterates what Miley said, which is the cost of transaction. That many different investors coming in with different capital types and how long that took is an incredibly expensive process. So just as we're all thinking about this answer that we need, which is, Miley's, how do we triple the size of this group? Part of that really has to be around efficiency and frameworks and investors that are continuing to co-invest together and kind of have an understanding of how they do it. But I think that, yeah, that's just one really good example of that opportunity and the challenge all at once where it can work. But it is really difficult to get that many different investors and different types of investors with different expectations all into one, to one deal. So thank you for bringing that up. I think going back and kind of unpacking the agriculture piece, because that does really, really touch on so many of the investors here. Chris, maybe you can give a little bit of perspective from Acumen around why are you investing in agriculture? Not just because you think that it's impactful, but also, where are their returns? And maybe you have something to share around those bigger questions of the right type of capital, the vertical integration, where the real opportunity is. And I think you guys have just a ton of data-based evidence of why you're making these investment decisions to share.
Yeah, well, thanks. It's a great setup and really great to go after Factory, who's a real colleague and a real insights builder for the space. And I think you're right. I think what we've done pretty well is since 2019 collected farm level data on what is the biggest resilience, and they don't even think about it as resilience, but the biggest resilience challenge and priority for them. Embed that voice into our investment decisions, because if you can build an embedded business model that's solving that primary solution and can scale at the same time, it's a virtuous cycle towards scale and impact at the same time. So that's what we're looking for when we invest. I think this stuff comes to light the best when we talk about examples. So I'll just give you an example. In 2019, we invested in what we thought at the time was a really innovative, sort of regeneratively agriculture focused company operating in Sierra Leone, that was operating in a sort of large, sort of centralized farm model that they were bringing smallholder farmers onto to train. We're offering large scale equipment out to local regional farmers to use to do primary tillage and weed control. They were providing on-farm jobs. There was a whole range of sort of what on paper looked like highly impactful and was highly impactful adaptation related training support and outgrow programs for farmers. The key point is the company had a centralized aggregation model and was asset heavy, right? 3 years later, the company had broken equipment, this bloated labor force, inconsistent sourcing from its smallholder farmers, quality was all over the place, margins compressed, balance sheet a mess. Fast forward through a lot of pain, a lot of failure, a lot of late night phone calls, the company's pivoted its business model. Instead of that centralized aggregation point, it now operates these regional trading hubs across 120 small farm villages At each hub, there's an agent who buys product from farmers, but also provides regenerative inputs and services on a 1 to 75 ratio. 75 farm businesses there, move the aggregation point closer, gets sent to a central fulfillment facility and then out to a larger facility that way. That company now is serving over 65,000 smallholder farmers and will cross 12 million in annual revenue this year, after we invested when it was just at 800K in revenue. Now, to my colleague's points previously, if this was a VC or anything even close to a VC, the moment that margin started to shrink, that investor is out, it's written down, and the company is defunct. If you recognize the challenges we all described, adaptation and the long-term impact, patience, structured capital in the right way, long-term accompaniment, technical assistance grants, you can get a company through a pivot like that and reach the impact and scale that it is now. But it takes time, it takes patience, and it takes the right type of funder supporting that initiative to get that capital out deployed. So we have the examples. It needs to be structured properly. More capital needs to flow.
Thanks, Chris. Maybe that's a good opportunity to go over to Matt. I know that as we've talked about before, and you gave a great intro, the work that you're trying to do is solve some of these capital problems, which is, you know, that the agriculture sector has these demands for these products and services. You can go out and maybe find small examples of those companies, but they're not at a scale that is meeting the demand of the farmers. And to your point, they're not necessarily ready for that capital. Can you just talk a little bit more about what those findings are, kind of what you're looking into, and then maybe how some of the work that you're hoping to do in that investment actually might connect into how, say, Acumen is already doing their investing, or how does that build to a company that can be scaled? I think Kat gave a really good example of, like, when these companies are scaled, they're providing these really important products and services, what that actually looks like. So can you kind of describe a little bit more what that, I hate to use a term that gets used all the time, but like, there is a missing middle, but you're at the small side of the missing middle that you're trying to address. Like, how are you trying to address that? And like, just describe a little bit more of that problem that you're trying to address.
Yep, happy to. So exactly as you say, we're kind of at that stage where we have a lot of investments we've been making over the past decade or so in the research and development for potentially transformative technologies. And there have been pilots, there have been early stage grant investments and quasi-grant investments in some of these spaces. But really, to get it to commercial scale, you've got to address some of these key market questions about the sustainability of the models, about cash flows, about risks that are in place to satisfy the requirements of DFIs and local investors and banks. So the missing link is really thinking about structured pathways from grant-supported innovation to the balance sheet strengthening types of investments that make businesses investable at scale. And our approach is really attempting to address this by working with partners to catalyze sustainable markets for commercial ag innovations. And depending on the technology, this includes addressing patient capital needs that are upstream, working capital for distributors, input credits for farmers, offtake guarantees, trying to analyze and understand the end-to-end financing needs across the value chain for these technologies. We're also trying to address, of course, key risk bottlenecks that make some of these investments unbankable. And the whole value chain approach really aims to ensure affordable, consistent supply and send the right demand signals through the financing stack. So we're talking about somewhat complex financing packages, which requires us working with different partners so that we make the best use of our grant capital to crowd in DFIs, local private capital, and others. And it's really about sort of demonstrating that commercial viability and the ability to sort of have the financing flows represent a feasible package that we can then take on, and the private market is able to start making those investments fully without some sort of concessional backstop from DFI and without things like insurance premium buy downs or partial credit guarantee fee buy downs that come from a philanthropic or other partner in that mix, and really enable it to demonstrate the feasibility without those concessional supports.
Thanks, Matt. Maybe jumping down to Lizzie, working very closely with those early stage companies, and kind of getting them ready for more capital. I guess my question really is like kind of like what's your response to like what Matt's sharing about what they're trying to do? Like is that going to connect to the types of companies that you're investing in? Or maybe another question is how are you as an investor sort of identifying the companies and then helping them grow even to that point that someone like Gates can come in with these other investors to sort of like show that viability?
Yeah, I mean, absolutely. It's an ecosystem. Like I don't know a single company we've invested in that hasn't gotten grant capital from somewhere. We do invest in, I'd say predominantly rural economic development, but it's as this is sub-Saharan Africa, this is agriculture predominantly. And we have found we're a bit of a pilot fund. We started doing equity, started doing debt. And then as we evolved, realized that every single one of our companies needed working capital. So it's really just about the sort of flexible financing, figuring out where other people can come in. Like there's, I think 50-60% of our companies now, we have a sort of just credit facility running, whether that's for trade financing or just for purchasing, to get them through that hump. I mean, it's what everyone else has been saying on this call. It's about patient capital, working with them through this journey. Like we want to get them to the stage where they can get to the growth capital, but this isn't a venture model. It's not going to be 2 to 3 years and it's never going to be a hockey stick. But if you want this sort of long-term actual development going in, like you need to be with them on this journey. And I mean, ground up investing is lucky in that we are patient and we are concessional and we understand that particularly in these markets, to get someone to market rate or even to get someone to a scale or a growth position, it's going to be a slog, and you might not see the returns that people want. And we're just happy that we're there and that we can do that. But yeah, absolutely. It's what Matt was saying. Like it is everyone coming in and taking a long time to get you find solutions like that. I think Kat was saying, like, you still need these bankable solutions. You still need things that you see are going to, in the end, be, have returns, be scalable, but it takes a while to get them there. And so it's about getting all of these players, all of the various investors that you've pulled together here, Sarah, to get on this journey. It's going to take 10, 15, 20 years, but it's this, yeah. So that's where we sit.
Yeah. I think that sort of going off that ecosystem question is a great transition. Amaka, you sort of talked about a bit of that ecosystem piece is actually stepping outside of like the traditional venture capital growth equity pipeline and sort of like looking elsewhere. Would love to hear a little bit more from your model, where you're looking for pipeline and like what those ecosystems are. Maybe you can touch on the type of capital that you're allocating or that you're sort of investing, or maybe the answer is a little bit more on that. Where are you actually finding companies and what are those different channels?
Sure. So for us, we have our own internal investment readiness program that we do. Again, we see a lot of the companies, right, apply through that. So we've built our own sort of like proprietary internal pipeline. In addition to that, we're very big on connections within the ecosystem. I've been working in this climate tech space for the past 10 years. And so, it's really around close relationships with the associations, with different associations, the renewable energy associations. We attend their events, and really going deep from an industry perspective. So we go to the big, ag conferences, and that's sort of where we find these companies, not in the typical, venture spaces that you would find them. So that's really how we approach sort of sourcing from a pipeline perspective. And what we find typically, if I look at companies that, outside we've, started investing in this 10 years ago, and if I look at companies that scaled, over the past 10 years, I think everyone is really right around, what we saw as then were the critical learnings that we've sort of implemented at Weave. So one of the things that I noticed was that, you invest in a company, most of them, like you said, I think needed some level of grant capital to start off. And it's very important, actually, when we're talking about grants, to be very careful about where the grants are going, because we've seen actually grants go wrong. And the question is, are you funding early stage innovation, or are you funding an unsustainable business model? And what we found is when you're funding the innovation and sort of that risk taking in those early days, it works. Where you start funding or subsidizing business models that even at scale can't work, then you open up problems for the ecosystem. In fact, when we're looking at companies today, we're actually looking to say, when we see you've got a lot of grant funding, it's a mixed signal, right? Because we've actually found a lot of companies are unsustainable because we've seen grants go into this space in poor ways. So that's one thing. So for us, in terms of how we invest, we really focus on saying, one, we understand the technical assistance is a huge component for these investments. And so we're very big on, similar to, I think a lot of people have said this, Miley's included, it's about really working with those companies and being very hands-on with those companies. We particularly focus on market level access. And so it's really around, if you need support with regulators, that's a big barrier for most of the companies. We then provide that support. But that hand-holding is very important. And it's very important to have pots of funding. So we have, a technical assistance pot that we're still in the process of creating, but it's a very critical area of support in terms of how we support our companies. Another thing is the ticket sizes. Most of these companies need strong ticket sizes, larger ticket sizes, especially when they've reached some level of scale. And the ability to say we're going to fund and lead you around is a big thing for us. And bring in other investors. So that's one thing. I'll say the ticket size and the ability to lead. The third element, which we haven't really, we're still cracking, is that fundraising risk. We find that most companies are not asset light, right? In this space, you really are, there's a level of asset heaviness that's important. And actually what we like to call it is being asset smart. And so you're capital efficient, but you do need assets to scale. And for those kinds of businesses, the biggest risk we have is saying, if you're coming in as an equity partner, which we do, and we have some flexibility to do debt as well, what happens to, you need a large quantum typically of working capital to make it work. And so we found ourselves actually spending a lot more time with building a coalition of other partners, including debt partners, that we come in alongside our investor into our portfolio companies, because we understand that if they raise only equity or even this minimal debt from us, it's not enough to sustain them. And so that coalition of debt partners is a critical one in terms of how we invest. And then I think lastly is that instrument, and it's touching on this, right? It's the instruments and the instrument mismatch in the ecosystem, I think, is a big challenge for most of the companies that we work with, because debt capital is just not readily available, especially when it's uncollateralized, and these are younger, smaller companies. And so having and working with them to navigate that is one of the core things that we do in terms of how we invest.
Thanks, Amaka. You said something that reminded me of the reason why I went into the finance side of development was because of seeing grant-funded programs prop up unsustainable companies that just sort of sometimes even broke apart ecosystems, because it created all of these misalignment and kind of incentives. And so you're bringing that up was just sort of a nice, harken back to 15 years ago of why I sort of was interested in all of these opportunities that all of you are sort of activating on. So, and I think you brought up a couple of things. My next question, which I didn't actually warn you about, Tofin, because Mercy Corps Ventures has been doing this for so long, my question for you is, why do you see companies fail in this space? What are companies that have seemed like they were good investments at the beginning? I think that Chris gave us a really good example of a company that had to significantly pivot because their original model just wasn't working long term. But what are you seeing for companies that don't make it, that had a good idea, but what was it about their model, their financing structure, the demand for their product, really anything that didn't work? Since you all have some really just good track record in things that have worked and also things that didn't.
Yeah, obviously, investing in this space require that kind of I would say patience. You'll have great companies that have a great trajectory, and over time, maybe something just didn't work out. We have a case, for example, in Nigeria where we had really a great company on the logistic and financing for logistics that was really scaling very fast. And I think there was like an issue, for example, on the team side, like founders didn't agree on the path, and such a drama, knowing how that company could have scaled. I think this is also one of the specificity in our model. I heard a lot of people talking about this on this idea of companies that have some sort of assets. I think that when we started, a lot of people were very hesitant about investing in companies that have ground distributions or assets. Over time, we see more and more funds coming to that alignment where if you want to build something that is sustainable and real in the real world economy, you can't avoid assets or distribution network. We wrote a piece, I think in December, kind of putting all of that together, and we call this pioneer species, which is very similar to what you find in real ecology. Like we like companies which are building those lower layers. Sometimes it's assets, sometimes it's distribution, but there is a notion of layers there where they don't need that much and they can almost build everything by themselves. And then eventually others will build on top of them. These companies tend to be a lot more sustainable. They are almost built by design to be resilient and adapt to any sort of shocks. And then obviously it requires patience. But another piece I wanted also to bring on this whole idea of success or failure, we like really companies where the founder basically kind of took the risk of building when everything was not yet fully done. Like, for example, this is why we do not do that much venture building, because we like to see the company, the founders have taken that risk, they have skin in the game, and also they are building on a problem they can't live with, like that's really dear to them. Sometimes when you are venture building, or sometimes when you are predefining companies, you might do it from like looking at what works in other markets. And you might find founders that do not feel like that's really such an urgent, but they're coming in most because the opportunity is there. So we like the idea of supporting companies once they've done that first stage. And then when we come in, we even have a grant program that funds pilots for de-risking a particular area of the business model, for example. So we felt like that is a lot more sustainable and a lot more interesting than taking it from the, like, let's say from the ideation, because the founders have done almost already some sort of work and they have already skin in the game and they have proven themselves and they prove that they have been able to convince others. So just responding back to the question, reason for failures are almost everywhere, from the team to the business model to the market. The success almost always here come back to building those early layers that the ecosystem needs. And this is even more important when you are building a less evolved ecosystem. For example, if you are building in Nigeria, already have a significant talent base. If you are building in Francophone Africa, it's a lot more difficult. So we take into account this idea of lower layers. If you master those lower layers, no matter the ecosystem, you have actually a great chance of succeeding. And obviously, just like Maëlys and others have said, we feel like probably 30% of the success is related to what you do post investment. You cannot just put money and sit back.
Thanks, Tafin, for sharing that. And I think that'll really transition to a question or a set of questions for Sandrine. You're coming into companies at a later stage with debt. We heard a lot of comments here about the need for working capital, the need for different types of capital, and I think that the development of your fund is really trying to address that. And you're also coming in where you've seen that success. You've seen like what those early things, those early risks, those early signs of success that some of these other investors have shared, you've seen it work, and it's at a point where companies are ready for a different type of capital. So can you just share a little bit about like why you structured the fund that way, what the purpose of this debt fund is, and then what you're seeing as when companies are ready for your investment, for your support, what has made them successful at that point?
Thank you. So I'll go back to 2018 because we were also selected as part of the launch of Project Drawdown. And there's been a lot of research, evidence-based research in terms of what's moving the needle for climate. We were also integrated the planetary boundaries into the design of the fund. So in terms of what is the purpose of this fund, it's climate adaptation. And it worries me today that I see a lot of funds that are trying to do mitigation, transition, adaptation, and they muddle the definitions. And at the end of the day, I'm really wondering, like, what will be the outcomes? So we're 100% climate adaptation, and we've linked 50% of our carried interest as a fund manager to 5 targets. Obviously, climate adaptation, job creation, gender equity, intra-Africa regional trade, and the youth and gender. So we really we have a big incentive to map where the capital is going to actually the outcomes that are realized. And then we're 80% LDC markets. Now, we provide later stage growth financing using debt. And what we've seen is that we've selected not just countries and sectors. And by the way, our sectors include 60% food security, but also health resilience, right? Because a lot of the folks in climate adaptation tend to zoom in into food. It's more than that. It's everything that's going to help a community or a business respond and adapt to climate shocks. And when temperature rise 2%, malaria, dengue fever, and other type of disease rise. When you have floods, you need emergency services, you need ambulances, you need coordination. So it's not just food security. So even though that is a good 60% of the portfolio for us. So the sectors are important. And then it's within the sectors, what are the verticals and the strategic value chains? So we decided to position ourselves in strategic value chains that has the evidence built that those are the essential climate adaptation products and services. But we've decided to go medium-sized businesses, and in LDC, they require smaller ticket size, and in some of our middle-income countries, it's a little bit higher ticket size, so we want to be flexible. But effectively, the mid-market company has a value chain. They work with, in Zambia, for example, over 7,000 smallholder farmers on a contract basis, right? So we want to be able to do middle size and growth capital because we want to be able to impact the greatest amount of people in the value chain and to trickle down the financing. So to the point that was mentioned earlier, we work with co-investors. And our debt is working because we have a blended finance structure. We have guarantees, we have first loss junior equity. We also need TA pockets. I'll talk about some of the innovative blended finance product that I see on the market that I'm really grateful are coming out on the market, and everybody needs to know about them. I think Sebastian is also on the call today, so I'll put a spotlight on him as well. Because we cannot exist and do our job as a fund manager without that catalytic blended finance structure. It's really important if we really want to go to least developed countries and to go to those sectors that are typically bottom of the pile. It's not big energy infrastructure, telcos, and financial services. So I think that blended finance piece is definitely critical. And then it's lowering the cost of financing for these businesses. So how do we do that? Let's take Zambia as an example. Local banks in Zambia are lending between 20 to 40% in local currency. So we basically found that African businesses, and that goes for early stage and growth stage, the same, do not have a sophisticated, efficient capital structure. It's inefficient because they're using bank debt to finance growth, short-term bank debt to finance growth, and there's a lack of an investor network. It's not like in the US or Europe where we know where to go to raise capital. So there's a great problem to solve, and we're part of that ecosystem. We can't solve it just ourselves. We need others. And I hope that this ecosystem that you bring together, Sarah, together with us on this call and at Gary can help us solve it. We work with, for example, I like to call it the fat bottom layer. So we have like a fat bottom layer of senior debt, and we work together with DFIs to do that. So that is low cost senior debt, 8 years, can be 7 to 10%, grace periods. And then we put our mezzanine debt layer on top. And then we find equity partners. So we have a lot of family offices that can come in as strategic operators on the equity side. Typically, the businesses that we've been working in Zambia, their cost of financing before us was 14%, and we could reduce it to 11% by coming in with that capital stack of co-investors. So all of us together actually helped make the capital structure of the company more efficient than before we came in. And that's really, really important because it has to be affordable. And I would say the blended finance structure is really, really helpful. So we have blended finance at the fund level, and we definitely need more first loss junior equity. We've raised 50% of that target, so we need a bit more. But we also work at the portfolio company level. So I have this great credit risk guarantee, which is in local currency. And for my portfolio company, they can take the credit risk insurance in local currency, and it covers principal and return. If you don't know it, it's called Damana, and it's backed by PICT, the private sector infrastructure development group. So Damana is a beautiful innovation. We can also do 20% local currency financing at the fund level, which is also a good innovation because some companies will only generate local currency revenues and they need to be supported differently. And then 80% of our portfolio is intra-Africa regional trade. Again, that is an adaptation strategy. Why am I importing wheat and maize from Canada, Mexico, or Ukraine when I can buy it from Zambia, right? So substitution of import is an adaptation and a resilience strategy because we're saying local production, local jobs, resilience. You still will have this product no matter what. And so I think that the other innovation I would mention is liquidity. So I think Sebastian is on the call with October, so I want to also shed a light on the work, the beautiful work that he does, because it enables us to basically attract pension funds, insurance companies that cannot stay 10 years in a close-ended fund. They need to be able to get out and get their liquidity. And October has developed a guarantee product that those investors can buy that liquidity option of getting out of the fund. So there's a lot of innovation in blended finance. It's not just funds like us, it's other partners in the ecosystem that are doing beautiful things that will make climate adaptation investment really mainstream and investable. So I'll stop here. I want to be efficient with the time.
Thanks, Sandrine. So we have 11 minutes left. And so I'm sort of warning all of the panelists here. I am going to follow up with a true rapid fire question at the end, and I've added you can answer one of two questions. The question that I sent all of you ahead of time, which is what 5 years from now would be like evidence that this is working, that the investment is working, that the investment is growing. The other question that you can think about is, do you have any big ideas of how to address how to triple the size of this group, how to scale it, how to address this? We need all of these different types of capital at scale. So those are the two questions. But my final sort of normal panel question, and then I guess a really quick, please keep asking questions in the chat. Most of the questions for the panelists were answered. So if you see a question towards you and you have time to answer that in the chat, please go ahead and do that. Or if you have another question for the panel, please include it there. We obviously won't have the opportunity to answer all of them. But my final, again, regular panel question is back to Addie. For myself, since learning about the Autodesk Foundation and the type of investing you do last year, I've been really encouraged that your model is incredibly flexible. I think that addresses one of the main issues that everybody's brought up here, which is sometimes the type of capital that's being brought in doesn't fit. It doesn't fit the company, it doesn't fit the fund, it doesn't fit the sector, it doesn't fit the growth model. Some of the capital is maybe risk averse to some of the things that we need. I think, Mylise, you made just a really strong case for that around there's these things that look risky to investors, but they're also directing towards the strongest revenue drivers. And so we need to address that at the investor level. And again, I think Autodesk Foundation just has had a lot of flexibility, which is really encouraging. So would love to just hear from your perspective, coming at this with flexible capital, how are you thinking about addressing some of these issues around, do we need debt? Do we need working capital? How do we get those different things? And what types of partners or investments are you making that are trying to address that specific question of filling in those type of capital fit gaps?
Yeah. Thanks, Sarah. Really rich discussion today. So, as a philanthropy, one thing that we do have is flexible capital. So, we're able to give grants for nonprofits and also going in equity investment. So, we think about it first about the problem that the company is trying to solve, and then can feed our capital to match what the company needs at that particular time. One thing we also think about is that arc of partnership, because as someone mentioned earlier in the panel, you don't want grant capital propping up companies that would not succeed like later on. So we do focus on design and engineering solutions, usually hardware, but not limited to hardware, but really thinking about, okay, at this stage, how are we being catalytic with our finance, but also with our technology addition? And what does that arc of partnership look like? So for a non-profit, it could be thinking about what will your end revenue be? Who would they sell to? We have seen some companies in our portfolio that are really figuring out that model of, okay, maybe at the beginning you're an implementer, you are working on technology, but soon you become like a consultant in a way. You're able to maybe lease your model or sell more to government. You're being more of like an enabler at the later end than an implementer at the beginning, right? So thinking about that partnership has been really important. Another thing to add is that where we do see our value as well is bridging that gap between research and implementation. So as someone mentioned earlier as well, we do see that need for like technology transfer and also fitting the actual adaptation outcomes to what the continent actually needs. So thinking about, okay, how can we use philanthropic capital to maybe seed innovative pilots within maybe disaster risk management? How do we ensure that it's actually tailor-made for the communities? And I think one thing to also add is that there is no successful A&R landscape without government at the table, right? Like this is definitely true for multiple sectors. Like we didn't touch about it here today, but like policy regulation, it's true for multiple sectors, but particularly important for A&R just because of the nature of the problem that we're trying to address. So for instance, we're working a lot in extreme heat and as a site that you would need like urban planning, optic at city levels, and that would definitely need that layer to filter in. So I think from our angle is coming in where we can early, looking at finance, looking at technology, but also thinking through like 5 years out, what would this success look like for this company? How are they thinking about maybe increasing their end revenue or also maybe figuring out what an could look like for equity investment. So I think that's a couple of things I would want to add there.
Thanks, Addie. I won't start with you for the final question. Again, for everybody, we really want to hear from these panelists. Big ideas they have to solve this challenge of the right type of capital and the volume of capital that we need. And then the other question to answer, please pick one and answer it quickly, is what does success look like 5 years from now? What actually like looks meaningful? Starting with Milise.
The privilege to go first. So to your first question, I think it's probably not just about more funds dedicated solely to adaptation and resilience, but also bringing in or bringing along other types of capital that would have traditionally invested elsewhere into the A&R space. And if you look at Africa, last year was 3.2 billion that overall went to startups across the entire continent. So it's a tiny fraction. And if we can move more of that to investments with adaptation outcomes, that's also great. So let's expand this room, both in terms of number of funds that are solely adaptation, but also maybe more generalist funds that need to look at this space. And then to your second question, I think a good signal for us to watch is how many companies that have adaptation and resilience outcomes will graduate to raising Series B in 5 years. And that will mean that pipeline is deepened, companies are progressing, there's enough scale to attract commercial investors to the space, which would be a great result.
Thanks, Milise. What about you, Matt?
I guess for the first question, I think capital flows when risk is measurable, priced, and shared appropriately among partners. So building that infrastructure for me really is the key part. So I'd say some sort of scaled Pan-African climate-linked ag risk platform to mobilize and crowd in local investors in particular, and really addresses some of those sort of correlated weather risks, first loss and catalytic capital, credit guarantees, things of that nature, including a lot of the local partners that already exist and are doing that work. In terms of sort of success, I mean, I think there's two. One is kind of in terms of an indicator of resilience actually working, and that would be measurable improvements in farmer incomes that are relatively stable despite weather volatility. And then the second would be an indicator of sustainable markets, and that's that local financial institutions are lending at scale for resilient ag solutions without any need for significant concessional backstop.
Thanks, Matt. Kiet, what do you think?
Yeah, I'll maybe just focus on the first question in terms of increasing the number of people here. And this is one that Sarah, you and I have talked about, but I really want to see more fund managers come along on this journey and embrace more creative and flexible structures of capital deployment. Certainly that matters for Factory, but I've seen a couple of other funds in the past couple of years try to stand up permanent capital vehicles, more commercially oriented and go to market to raise. And after 8 months or a year, have to pull back and pivot to a closed-end 10+2 commercial fund model because no one can get that past their IC because it's unfamiliar. And so it just creates this inertia of more of the same for a model that we know is not fit for purpose on the continent. So I would like to see fund managers come along on the journey, embracing more new and creative models of capital deployment as a means of getting more of the right capital to the table here.
Thanks, Kiet. And Amaka, what do you think?
So I think, yeah, pretty much two things. You mentioned something that really stuck with me, which is adaptation is non-negotiable. And really, the best companies should be thinking about adaptation regardless and of whatever vertical you identify, you call yourself as a company. And I think one thing I want to we'll see as progress is if every company starts to see that as a critical component to surviving and thriving as a company. The second thing I would say is really around the LPs and bringing together more LPs to understand the need for these blended models, because at the end of the day, if a fund manager comes in and says, I want to do these, catalytic capital, I want to have a blended fund model, I even want to have some debt plus equity, and no one wants to fund that, then that becomes a challenge. So I think there needs to be a lot of LP education around this and the need for flexible structures that are fit for purpose. That's it.
Thanks, Maka. Lizzie, what do you think?
Yeah, I'd say the one sort of caution is like a tangential to your question is that everyone is talking about scale. Like we want to get more money into the sector. We want to there's still a missing middle, and scale is not always the answer. There are still, you need the ticket sizes that are 100, 200, 300,000. And so we need to be cautious as we push for just getting more money into the space to make sure, as everyone has said on this panel, that it is fit for purpose and that it is right-sized. And that we need to be careful because, as we start moving towards the billion mark, that we are looking at what the actual needs are on the ground and making sure that we can tailor the financing structures for those companies and those sort of solutions that are actually there. So that's my sort of caution and hope for the next 5 years.
Thanks, Lizzie. Tofin, what about you?
Yeah, a couple of points. On the big idea side, I really like the idea shared by Sandrine on the blended capital. I worked sometime on the Chamas industry, like Chamas, Isuzu, Tontins, and I feel like we are still probably missing an instrument that properly blend equity and debt in a sense, especially now that most of us kind of accept the idea that great companies may also have physical asset, ground distribution network, not just software. So it means that we probably have to embed those kind of blended financing and provide more innovative models. Like, for example, a tontine is not like a credit, it's not a saving. We tend to say rotating saving credit, but it's just an instrument that has been here for so long and historically here. I wish we had something like that in the VC tech industry over time. On the second question, I think one of the probably pending points for us to double or triple this urgency is also, let's talk about exit. Like, for example, I really wish more industrial players in most of these sectors and value chain we are trying to modernize, whether it's in agriculture, in energy, and others. I wish more industrial players join in and potentially acquire some of those startups and basically accelerate things that they may not be able to do internally, whether it's in insurance or fintech. I think that we need to talk about that topic because that also shows concretely that adaptation itself is not just a moral issue; it's also a proper economic opportunity. And then having more exit and recycling more of that capital back to the industry will probably double or triple the audience that we have here today. Thank you.
Thanks, Tofin. Sandrine, what about you?
All right. So I would say 3 points. I would like to see case studies of investable adaptation investments. And the reason I'm going to quote a quote that I've heard just recently on another webinar, the abstract attracts the demonic. So the idea that without concrete definitions, basically these concrete definitions would protect against manipulation, right? We need to move beyond the abstract into case studies of investable projects to educate investors that may not understand even the definition of climate adaptation, right? And we need to show them what it means, and we need to, I hope, get to a measurement level that we can say at the community level, we've improved the ability to respond and we've reduced the threat. That is the big dream, right? And then for those deals to be truly transformative. And then the other aspect of the coin for me is the private sector mobilization. And we operate in Africa where private markets, 80% of our capital is coming from a European government. So at first close, we have a very modest first close near the 30 million, but it's 70% private sector capital and it's 40% African capital. So I'm really proud of that African capital has been mobilized, both pension funds and also high net worth individuals. And I think I'd like to see more pension funds and insurance companies mobilization in Africa. I think we have some really good pathways for that with the work of FCDO or the Mobilist that are working with stock exchanges and the private pockets of stock exchanges. It's not just becoming a listed vehicle, but that can be a great way to mobilize African institutional private sector capital. And then the other side of the coin is Canadian, US, European pension funds and insurance companies that are really late in the game, besides a few, in terms of investing in frontier market and places like Africa. So I would definitely like to see the needle move on that pocket of capital as well. And I think that some of the tools that are being used, whether it's political risk insurance, liquidity guarantees, other type of catalytic capital is going to help us hopefully attract and mobilize these kind of pockets.
Thanks, Sandrine. And last, Addie, back to you. What is your final thoughts?
Yeah, I think just to wrap up, what would be success for me is like seeing the actual impact outcomes. So hopefully 5 years from now, I want to solve the same problems. Like I've seen like it moving the needle, a step change at least for the problems we're solving. So I think that those impact outcomes are important. I think the next thing that would be important for me is like more innovative business models that are figuring out who's paying, that are figuring out a more sustainable like approach to A&R. And then finally would be like more stable regulation and policy.
Thanks, Addie. And thank you to everybody for staying a little bit late, listening to all the really just insightful thoughts from all of our panelists who are doing this tangibly every day, who are working with these companies, who are identifying what these real opportunities are. So I'll leave those final thoughts as the final comments. So thank you everybody for joining. And we look forward to just continuing the conversation. This is what Gary does, is we're trying to bring people together with the outcome to move capital. And I think we had a lot of ideas about what's needed, what's working, and how to do that here today. So thank you so much to our panelists and for everybody for joining.